Hi, my name is Stephen Rodneski from GetRealOnTaxReform.info. There is a great deal of misleading information surrounding the current political debate. In this video series, I'm going to examine the facts behind the rhetoric. Everything being proposed by today's political candidates has already been tried, so we have real data about what were the effects of these ideas on our economy, if we only bothered to look. To paraphrase the old saying, those who don't bother examining history are doomed to keep making the same mistakes. Let's see if we can learn from history and have a little fun along the way. It's a well-known fact that many species of sharks must constantly swim or they will cease to exist. You might ask, what does that have to do with cash and tax reform? Well, cash must also keep moving through investing or it will slowly cease to exist as well. For example, you might have a jar of coins like this one with $100 worth of change in it. You probably won't be too upset to discover that it'll only have about $97.50 worth its current value a year from now. But if you had $100 million that you had just stuffed into a safe rather than invested, I guarantee that you would be very concerned that it had lost $2.5 million in buying power in that year and will continue losing value with each passing year. Why does this happen? Because inflation is constantly whittling down the value of money. That's why it takes $4 today to buy the staples you could purchase for about $1 back in 1976. So anyone with a large amount of money would be a fool to keep it tucked away in a safe or under their mattress. Now, I don't think there are very many fools around with millions of dollars laying around. Even if they aren't particularly shrewd with money, a wealthy person can afford to hire an expert to invest for them. You don't even need to be an expert. It's a well-known fact that cash not needed for living expenses and emergencies must be invested with a decent rate of return just to keep up with inflation. That is why I find it inexcusable that Congress claims to be looking out for our best interest, yet keeps expanding this massive loophole to the wealthiest among us for doing what they have to do anyway. Chapter 7 in my book, Conning the Rich, The Great American Fraud, covers this more thoroughly. Of course, our friends in Congress try to justify their actions by couching it in Madison Avenue terms, such as, it's to encourage savings, and referring to those who benefit most from the tax breaks as job creators. And we, the voters, keep buying this load of cow stuff. First off, businesses only create jobs for one reason. They believe that the money they spend on the employee will be less than the money they make off the employee's efforts. Now, don't get me wrong. I'm not criticizing businesses that hire people. I'm just suggesting that we should also be practical and stop romanticizing what job creation is all about. Adjusting the taxes paid on income generated through business profits will not affect whether employers will hire additional employees. There are companies sitting on billions of dollars and taking advantage of tax breaks and still not hiring additional employees because they don't need them. Government can encourage businesses to hire additional workers by tying certain tax breaks directly to the business's hiring practices. But that's an entirely different discussion. Over the past 3 decades, those of us making less than $500,000 per year have been kept with higher taxes so that massive tax cuts could go to the super rich. Now let's face it, we don't need to encourage savings by giving extra tax breaks to those making over $1 million per year. because they not only have the excess cash, but they have to invest it, as I explained, to keep up with inflation. Rather, we need to cut the taxes for the rest of us who make less than $500,000 per year, so that we will all have a little money left over to save and invest. We don't really have to depend on the super rich for investments. It's been proven that the middle class is more than happy to invest if they have some money to do it with. Now, there are those who will argue that long-term capital gains tax break is fair because it's open to all. But let's look at the summary of what happened in 2008. The government issues a great many reports each year. The one on the screen behind me is the IRS summary of all individual returns filed in 2008. As you can see, there were over 142 million returns filed, and together they reported over $8.2 trillion in adjusted gross income. You also see that total is then broken down into 19 different groups based on their income range. And the bottom 5 groups together cover incomes of $1 million or more. The report also breaks down the total into different categories, showing how much of the $8 trillion worth of income came from salaries and how much came from things such as long-term capital gains. Now, the next slide pulls out the totals from the IRS report, along with the 5 groups that make up the individual reports of $1 million or more in income. You notice that beside the total column and the number of tax returns and the adjusted gross income, there are columns reflecting how much of the total came from tax-exempt bonds, how much came from long-term capital gains. The first thing that we discover is that together the 5 groups reporting income of $1 million or more included about 327,000 filers. I call those filers the super rich. Those 321,000 filers made up less than 1/4% of all tax filers. Yet their income was over $1 trillion of the $8.2 trillion the entire population gained. We'll analyze the implications of those facts in other videos. Right now we are just looking at the long-term capital gains. Of that $8.2 trillion in total adjusted gross income, about $528 billion was from long-term capital gains. The question is, who actually benefited from this tax break? Well, as you see, of that $528 billion in long-term capital gains, $335 billion went to the super rich. That means over 63% of the long-term capital gains went to the super rich, who used it then to protect over 31% of their total income from that 35% tax rate that was supposed to be levied on all income over $373,000. This is one of the loopholes that allowed candidate Romney to pay less than 14% income tax on over $21 million worth of income. Now, this is not a trivial point. In 2008, the super rich, who made up less than 1/4%, received over $67 billion in tax breaks from this one loophole alone. For those who want to verify my figures for themselves, check out the file on the IRS website labeled 08IN01AR.XLS. In reality, the long-term capital gains tax break is open to all in about the same way that anyone who wants to purchase a Lamborghini is welcome to do so. Just make sure you have a few $100,000 laying around. The propaganda machine working for the super rich keep coming up with more misinformation, such as the statement, long-term capital gains tax is double taxation. Now, I personally know otherwise sane, intelligent people who have fallen for that one. Well, let's look at the facts. If one invests $10 million in stocks, land, or whatever else that appreciates, then sell it 1 year and 1 day later for $11 million, he would not pay tax on the entire $11 million, because that would be double taxation. Instead, he would only pay tax on the difference between the purchase price and the sale price, which was $1 million. That is the income that has been realized off the sale of the investment. Of course, you don't have to take my word for it. Just look at the IRS Schedule D form where you calculate capital gains and losses. Another rationalization used in the misinformation campaign is that there should be extra credit for the risk inherent in investing. Generally, the risk for investors is higher relative to the greater potential return. As you can see, it seems that super rich want to maximize their potential return despite the risk. For instance, a low-risk form of investment is tax-free bonds. The problem is they don't provide much return on investment. As you can see here on the chart, on average, tax-free bonds make up only about 2% of the income of the super rich. Whereas, as we saw before, riskier long-term capital gains investments made up over 31% of their average income. Besides, risk is not just something which capital investors have to cope. Every businessman takes risk all the time. I can't even count the number of times that I have invested in advertising campaigns or trade show booths that have not even covered the initial investment cost. It's part of the risk of doing business. For that matter, even salaried workers take a risk. They work up to a month in advance on the promise that the company will pay their salary. Now, granted, their risk is low because normally failure to pay employees' salaries usually means the demise of the business. However, in cases where the business does fail, employees stand to lose more than unpaid wages. Their retirement accounts can also be lost or devastated. Now, this is not a new debate. Even President Abraham Lincoln, that famous Republican, spoke out against the notion that capital should be favored above income earned through labor. Granted, even though the super rich get the most benefit out of capital gains and that tax break, it can also help other taxpayers at times, as was the purported original intention. If the thought of eliminating the long-term capital gains tax break disturbs you, check out the video titled, "What About Me?" to learn about a much fairer way to protect unusual income fluctuations over taxation. Giving people with large investment portfolios another tax break for doing what they would do anyway makes as much sense as giving special tax incentives to heterosexual teenage boys to encourage them to spend more time thinking about girls. There is a great amount of information on my website, getrealontaxreform.info. You might find some of it useful. You're welcome to check it out. If you found this video interesting, please like us below and share it with your friends and associates. The info I am presenting will only be a footnote when historians try to piece together what went wrong in America, unless the country wakes up in time to reverse the trend that I've noticed has been accelerating in recent years. If you want a copy of the table on capital gains and super rich shown earlier, go to Facebook/GetRealOnTaxReform and like us. You will get access to that table along with other charts and reports. And you will be alerted when new videos are available. Thank you very much for your time. And God bless America.